Right then, people, Big Short Club is live. I've managed to drag Morgan away from his 4 screens of doom. Mate, you look like you've been crunching numbers since the Big Bang.
Says the crypto guy who probably thinks diversification is owning both Bitcoin and Ethereum. At least my charts represent actual, economies, not just sentiment swings from a podcast.
Oi, you leave Joe Rogan out of this. That's a valid indicator. Look, we're not here to argue about fundamentals versus vibes.
Okay.
Today, we're peeling back the curtain. We're talking about why the big dogs, the institutions with all the money, don't just look at one chart. We're talking CMT Level 3, multi-asset intermarket models.
You're finally graduating from meme stocks, are you? It's about time. Welcome to the world of grown-up trading, Chris.
Yeah.
This is the stuff that separates the players from the public, is the institutional edge.
Yeah, I'm all grown up. So this intermarket stuff, break it down for me. Is it as complicated as it sounds?
No, the concept is simple. It's just that nothing in the market happens in a bubble. Think of it like a human body. Stocks are the muscles, right? The flashy part. But bonds are the nervous system sending all the important signals. Commodities like oil and copper are the food and energy.
Right.
And currencies are the bloodstream moving value around. So if one part is sick, the whole body feels it. Intermarket analysis is basically being the doctor who understands the whole system. Okay, that's a decent analogy. I get it. So give me an example. Let's say the US dollar starts pumping. What does the doctor see? Okay, so the dollar, the DXY, is spiking. First, commodities priced in dollars, like gold and oil, get more expensive for the rest of the world.
Okay.
So their prices tend to fall. That's rule one. Second, a strong dollar can mean a flight to safety.
Right.
Money is flooding into the US. That's a risk-off signal. And that's usually bad for stocks, especially in emerging markets. And yeah, bad for your speculative crypto coins.
So just by watching the dollar, you get a weather forecast for the whole market.
Yeah.
That's why the big funds are obsessed with this. It's their risk radar.
It's their entire dashboard. Imagine trying to fly a 747 just by looking out the front window.
Wow.
It's madness. These models are their altitude, their engine status, their fuel gauge, their weather radar. They're managing billions of dollars.
Right.
They can't afford to be surprised. Their number one job isn't to make money. It's to not lose money. So it's a defensive play. They're looking for the first domino to wobble before the whole line comes down. Exactly. And the first domino is almost always in the bond market. That's the real smart money. The bond market sniffs out economic trouble months before the stock market does. The bond market sniffs out economic trouble months before the stock market does.
If bond yields are screaming higher, it means the cost of debt is rising, and that suffocates business growth.
For an institution, a sharp move in bond yields is a massive siren going off.
Whereas for me, a sharp move is when a coin does a 50x because a dog got elected CEO. It's a different world. But this sounds like it's all about defense. How do they use this to attack? To, make profit?
That's the next level. That's alpha generation. The relationships aren't 100% perfect 100% of the time.
Okay.
The quants, the maths wizards, build models to find temporary disconnects. For example, the price of the Aussie dollar is tightly linked to the price of iron ore.
Yeah?
Yeah? If iron ore rockets up but the Aussie dollar lags behind for a few hours, that's an opportunity. The model flags it, and they pile in, betting on the currency to catch up. It's about exploiting tiny, temporary cracks in the system.
Right, so they're basically arbitraging the relationships between markets. That's sharp. This is way beyond just, drawing a trend line, isn't it?
Miles beyond. This is why you hear about quant funds at places like Renaissance Technologies having insane returns.
Wow.
They're not betting on whether Apple will beat earnings. They're betting on a million tiny relationships across the entire globe all at once.
So for the average bloke listening to this, who doesn't have a PhD in physics, how can they use this? We don't have quant models.
You don't need one. You just need to broaden your perspective. Before you take any trade, stock, crypto, whatever, have a quick glance at 3 charts. The dollar index, DXY. The 10-year treasury yield, TNX, and crude oil. That's your dashboard.
The holy trinity.
Exactly.
Is the dollar spiking? Are yields collapsing? Is oil tanking? Those are massive risk signals.
Right.
If you're about to FOMO into a hot stock, but all three of those are flashing red, you're like a surfer trying to paddle out into a tsunami. It doesn't matter how good a surfer you are, you're going to get wrecked. Don't trade in a vacuum. I like that.
Yeah.
It's about knowing the weather before you leave the house. That's proper street smart trading. It's the difference between gambling and speculating.
Right.
You're using information from the entire environment to inform your decision, not just one isolated pattern. All right, my brain's starting to smoke. That's some serious alpha. Maybe there is something to this TradFi stuff after all. Just maybe. It's never too late to learn, my friend. Cheeky git. All right, listen up, everyone. You know what to do. The link to our private chat group is down below. Hit that. Come and have a laugh with us. And if you appreciate Morgan explaining things without making you feel like an idiot, thank us by signing up to our recommended crypto sex with the link in the description. Costs you nothing and helps us out. Now, we're leaving you with a big one to think about. Here's the question. If you had to pick just one intermarket indicator, bonds, currencies, or commodities, to be your primary guide for market direction, which would you choose and why?